Hey friends, good evening. How are you? I am in Fremont, California today. As you all know, I do this Facebook Live on Fridays at 1 p.m. Central, and I am in California in Fremont. It's a great weather here and very sunny. It's 11 o'clock, so it's good morning to all of you out there. So I am here today to talk about charitable LLCs. What is charity, and why does charity get a tax deduction, and what are the different ways do financial advisors or tax preparers or tax planners do to creatively write off insurance through charities. So we have in the last 10 years of practice, we have been seeing all kinds of strategies or scams or ways where people come up with ideas to deduct insurance premiums from charitable contribution. So first thing I would say is these kind of strategies may not be the right things to do, but there are very smart attorneys who might have come up with a beautiful structure which makes sense and which can hold water and which can easily be proved in case of an IRS audit. But one has to be very careful as to who they work with. So charity by nature is something that IRS is willing to give a deduction for. A public charity, when you basically make payments to a public charity, the deduction that you get is up to 60% of your AGI. President Donald Trump changed it to 60% this year. Till last year it was 50%. So if you make a payment to, say, a temple or to a church, you basically get a deduction of up to 60% of your adjusted gross income. Now, in the same token, there is also something called as private foundation. Private foundation is something that you create for yourself, and the money that is put there as a donation is being used for the purposes that is written down for the charter of the organization. It is a charity, but more of a private charity. It is created by you privately, and maybe for some of the friends or relatives or even others who could contribute into this, but majority of the foundation money is coming from you. So the contribution that one can make in a private foundation is up to 30% of AGI versus 60% in case of a public foundation. So private and public we talked about. Now there are ways where one can take a deduction for charitable contribution because of certain investments. So certain investments, when I say there are strategies such as land conservation easements, where you basically invest X amount of dollars in a private fund, which then buys real estate using that money, and by the end of the year that property is contributed to a conservation fund for conservation of that property, and you get a deduction. Now for that, the limitation is 50% of AGI, not 60%. So there are different limitations for different things. And while all these strategies are out there, we have also seen some strategies that a few tax preparing firms as well as few attorneys have implemented over the last few years, and some of them have come under tremendous stress because IRS has been watching these strategies, and they have been going behind some of these strategies, and they have been busting some of the strategies, and it is becoming a problem. So a strategy called as Charitable LLC, wherein the taxpayer contributes his assets or cash, and that LLC is then donated away to a public charity or a private charity, and the money that is lying in the LLC is used to buy life insurance. This strategy has come under tremendous stress. So I suggest those who are trying to get into this kind of a strategy to please think twice, understand what you're doing, because you really don't need to just go and sign up for something without understanding it. There are tax planning firms which basically make you pay a certain fee and ask you to get into the plan, and they don't explain you the plan. So it's very important when you sign up for something, whether it is financial planning, tax planning, estate planning, or anything for that matter, any expense or any spend that you're making from your pocket, you need to first understand what you are getting into, because there are a lot of bad people out there and you don't want to get caught because of their deeds. You need to make sure that whatever you do, you are on the right side of the fence. So please make sure that these kind of charitable strategies that somebody is trying to sell you, you please do your due diligence and invest your money in that only if it makes sense. So that's about strategy. So we talked about public strategy, public foundation, private foundation, charitable LLCs, as well as conservation easements. Each one of them has its own pros and cons. So you may want to talk to your tax preparer or tax planner or financial planner to understand, how each one of these impacts you, your tax reduction, possibilities, as well as the financial growth of this investment. Last week I talked about tax equity, where you basically invest in a business and you get the tax benefits of that business because you invested in that business. So solar is one such area where you can invest your hard-earned dollars and get the benefits of the tax credit, as well as the financial growth that comes from this particular investment. But again, there are clean people who do the right thing. The tax code has to be kept in mind while you do this kind of a strategy, because these are extremely creative and extremely risky strategies. So you'll have to make sure that you work with the right set of people, the right bank, the right attorney, the right tax preparer, and the right financial advisor when you get into such complex strategies. So that's all about it today for this Friday afternoon. We talked about charities and we talked a little bit about solar equity, tax equity, and the timing is right, to discuss these things right now, because we are in early October and we still have 2.5 months for the year to end. So this is the right time to plan your taxes. At MyTaxFiler, we do tax planning for those who have a need for tax planning, particularly those who have an adjusted gross income of more than $600,000. It makes a lot of sense. Rather, I would say it is a mandatory that you should plan your taxes if you're more than $600,000 in AGI. If you have a business and it's doing well and there is a lot of taxes that you're paying, you may want to talk to your tax planner and understanding your options, because federal tax itself is about 37%. So 37 cents on a dollar is going to tax just on the federal tax. If you live in a state which has a state tax, such as California and New York and New Jersey, you pay additional 10 to 12% to the state. So a tax rate of about 40 to 50% can be saved by proper planning. So that means a lot of money that you earn with so much of time being put in or so much of capital being put in needs to be preserved. And tax planning is the right way to do it, because every dollar to make, every dollar you need to earn $4, right? So you need to make sure that you save every bit of it, and that money is invested towards your retirement, and you have a passive income stream after age 65 till you live. So that's our motto at this point. Save your taxes, build your wealth, and make sure that you have a happy and a successful life. Thanks again, folks, and I'll come to you again next week, same time, with some other topic. Until then, have a good weekend and take care. Thank you.